Welcome to Dezerv's monthly market update. In the last few weeks, we have seen a significant correction in the equity markets. And in today's episode, our co-founder Vaibhav Porwal will take us through three important aspects. First, what are the factors causing this market correction? Second, how should investors navigate their existing investments? And third, our future outlook and recommendations for investors. Let's dive in. So Vaibhav, we have seen a significant correction in the equity markets since September 2024, and this correction has accelerated further in February. And of course, this is very concerning for investors. So I have two questions here. First, what are the factors that is causing this correction? And second, is this correction normal?
Let me address the second question first. See, corrections are natural. They are part of the normal journey of the market. Every other year, you will see double-digit corrections in the market. So obviously this correction is part of the normal course of the market. So let's get that out of the way. Now coming to the current correction. The current correction was in the making for quite some time. We had spoken about this at length, that markets were looking expensive, and in particular mid and small cap segment of the markets were looking expensive. Now when markets trade at these high valuations, you need everything to go right for the market, which means your economy has to grow at a high pace, your earning growth has to be very supportive, and geopolitically also things should be very stable. Unfortunately, all three factors did not work out the way markets expected them to. Geopolitically, we started seeing a lot of unrest with aggressive trade policies of Trump administration. GDP growth slowed down in India, and corporate earning growth, which you need to support high valuation, also slowed down. So it became a perfect cocktail for markets to correct. So this correction was in the making. Now there is third layer to this, the degree of correction. The degree of correction is very different across different segments of the market. In case of mutual funds, the correction is much lower. In case of direct equity PMS, correction is higher. In case of direct stock portfolios of the investors, the correction is much higher. So all three segments have experienced different degree of correction. So when we are looking at correction, I think it's important that we break it down like this.
Right. So let's go in a one by one. What is the kind of approach that investors who are investing in direct equity should take?
India has, and as Indians, all of us have this morbid obsession of picking stocks. And I'm saying morbid, there are very few exceptions who have been able to do better than the market. In my experience of 22 years, I've seen 98% portfolios, direct equity portfolios, underperforming the market. We still like to select individual stocks. Compared to the developed market, our allocation to equity through direct stock investing is much higher. When you look at developed markets like US, more than 80% of individual investors' money in equity markets come through professional fund managers. The ratio is very different in India. Now it creates two problems. Direct equity investing requires professional expertise and time allocation. Obviously, individual investors can't allocate that kind of time, and also doesn't have that kind of professional expertise, which means they are taking significantly higher risk. Second, in direct equity specific, the correction degree is very different across different stocks. So when you look at the data, there are more than 45% stocks which have seen correction of more than 40% in last 6 months. If you are holding these stocks, then the severity of correction is much higher. Now the second point is, recovery period for some of these stocks can be very long. We did this analysis of stocks from 2008 till 2025. You will be surprised to know that 25% of those stocks are still in losses after 17 years. 20% of the stocks on top of these 25 have generated returns less than 8%. Now imagine you are invested in direct equity stocks and you have to go through this. It becomes extremely difficult. So my suggestion and strong recommendation to investors who have invested in direct equity stocks is to move away from that, analyze them, use expert, maybe Dezerv, and move your portfolio towards mutual funds.
So talking about mutual funds, what about investors who already have invested in small and mid cap mutual funds?
See, we have this misconception that small and mid caps do much better compared to large cap always. Always is an important term here. This misconception got built because of the performance that small and mid caps gave after COVID. If you look at the data before COVID, returns of large caps were in line with what mid and small cap indices delivered. So there is a little bit of recency bias at play here. Investors who started investing after COVID have seen high returns in small and mid caps, and therefore they worked with an assumption that mid and small caps will do better than large caps. Now, when you are investing in any category in equity market, what is important is your entry valuations. If your entry valuations are not right, whichever category you invest in will disappoint you. And right now, mid and small caps are still much more expensive compared to large caps. So there is no clear formula or rule of thumb to say that mid and small caps should be giving higher returns than large caps. It depends on your entry valuations, and therefore you should take much more dynamic approach. And I think there is an interesting controversy around this on the SIP in mid and small cap.
Right.
My view there is, when you are investing in SIP, and the reason for which we have imagined our SIP very differently and said that we'll do dynamic SIP across different market cap segments, is to address that. We want to see whichever segment of the market presents the best opportunity, money goes there instead of a fixed SIP going to a particular segment of the market. That's how I think investors have to look at mid and small cap allocation. No clear rule that mid and small caps will always give you better returns compared to large cap. In the current market environment, large caps are placed much better compared to mid and small caps. Third point, if you are invested in mid and small cap, the time to recovery is much higher, and maybe it's time to rebalance some of your portfolio in favor of large caps. So these are the recommendations that I would have for someone who has been investing in mid and small caps actively over any other segment of the market.
Right. And what about allocation to direct equity PMSs? There's also misconception that direct equity PMSs, give significantly higher returns compared to mutual funds, but that's not really the case.
So we have seen that data, Namrata. Most of these PMSs end up investing in mid and small caps. Again, going back to the same point, when you're investing in any asset class, look at your entry valuation. The other associated point is, many of these fund managers are not very experienced in seeing the cycles, market cycles. So my recommendation again would be to review your PMS allocation and rebalance it much more in favor of mutual funds. You can do PMSs selectively, but you have to be extremely selective there.
So those are your recommendations on their existing investments. What should investors look at for their future investments?
I think few learnings from this correction. First, corrections are normal. It keeps happening. We have data to support the argument that if you invest in the market after a period of correction, your subsequent period returns are higher. So there is an opportunity that investors should capitalize on, because your future returns will be higher. Second, rationalize your expectations from market. We have started normalizing 25-30% returns, which is not normal for the market. Normal range of returns for the market is 13 to 15%, and that's what investors should expect. Third thing, look at asset allocation seriously. Asset allocation has been a proven concept for last 30, 40, 50, 70, 100 years. So don't shun it in favor of short-term movement of the market. And last, look at different segments of the market objectively instead of using a specific rule of thumb or a specific formula to say that I want to only invest in this category. And an additional point is consult your investment experts at Dezerv and get your existing portfolio reviewed and draw up a plan for your future investments.
These are some very relevant points for investors. Thank you, Vaibhav, for summarizing it so well. This will hopefully help investors navigate the current market environment and face the market corrections. Thank you.
Thanks.
That's all for today. See you in the next market update.